Hey guys, we are back with another quick episode of the Crypto Yield Curve podcast. With me here is Gaurav Patel, and I'm Jason, and we're working on Rheo, a fixed rate lending and borrowing marketplace. And just before we start here, we'd like to show off our stocking stuffer rewards campaign. And this will run for a couple of weeks, and there's pretty good USDC rewards being paid out if you lend against these different categories of collateral on Rheo. So as you can see there, you can earn up to 35%. And great chance to just check out the fixed rate protocol and let us know what you think.
All right. So the topic of the day is there's been a back and forth between Haseeb and Santiago on crypto Twitter, and just want to give my own opinions on that. So basically, Santiago started with a very uh, skeptical post, I guess you could say, about the valuation of crypto protocols, but I think mainly focusing on L1s. And I think it was, it's been a couple of weeks, but I think it started with the Monad um, token launch, if I recall correctly. And basically, the Santiago's argument is that the crypto protocols are valued too highly. If you look at other network effects businesses such as Facebook. So, the Facebook per user valuation is about $500, and the crypto, excluding BTC, the valuation. So basically, smart contract platforms valuation is something like, depends on how you define the user, but anywhere from $2,500 to $23,000 per user. And here it is in kind of graphical format. Again, this is defining depending on how you define a crypto user, but really the on-chain user is like super highly. Um, the valuation of the protocols is super high if you use on-chain users as your defining user. And Haseeb basically said he's on the other side saying, hey, like just wait and this stuff's going to grow, and I'm probably simplifying his argument, but like we're at the kind of at the base of the exponential curve, and so it's it'll the justify the evaluations will end up justifying themselves sooner or later. And I thought this is a very interesting dichotomy, you could call it. Let me just zoom in on this Haseeb post a little bit here. And just keep in mind that these are both like venture capitalists, and they both invest in some of these projects, including some of these all ones. I don't know which. I don't know the details about which of these two people invested in which L1. But let me just stop sharing screen here so I can. There we go. So I found it. I've always found it kind of interesting how among people in finance, there's a big difference in how people think about valuation. So if you look at Wall Street analysts of mature companies, maybe private equity analysts, they're much more in the classical value investing framework. They look at the most simple ratio being a PE ratio or price to sales ratio, and then some of them add layers on top of that, discounted cash flow or price to sales accounting for growth, and or the Buffett style framework is really low price to earnings ratios with a moat attached, so that earning or you can raise prices year after year, and the earnings will keep growing. So it's, his framework is not, it's not enough to buy cheap stocks or cheap companies, cheap businesses, but you want to buy cheap businesses that have some sort of defensibility where the denominator, the earnings or the sales will keep growing year after year. And then if you talk to like a Silicon Valley venture capitalist, they really do not care about any of that stuff. And their mindset is, hey, it's too early to worry about this stuff. Like, let's say you had a company with a PE ratio or price to sales ratio. Sometimes they don't even have earnings, these companies, since they're in growth mode. But if they have a price to sales ratio of let's just say 500, okay, that seems expensive to the private equity analyst or the person who's doing the discounted flash cash flow analysis and using that as a valuation starting point. But if if the sales grow at 10x in a year, then your price to sales ratio is going to be 5 next year. And it's actually going to be a cheap business to buy next year. And by extension, like it's going to be cheap this year, actually. It looks like it's expensive if you just take the instantaneous snapshot, but it's going to grow so fast that it's going to be a cheap business very soon. Um, and so really what the venture capitalists they look for is exponential growth of some sort. And you can refine that as saying exponential growth with retained users. So it's not just like short term advertising spend or something like that, but they're really just they see this business as an organism that's going to grow exponentially. And exponential curves are hard to model, at least for human intuition. And so you get very different mindsets um, between the two parties. And then VCs also they always acknowledge, or they always have as part of their mental model that the current use cases may not be the only use cases. That we can't predict what additional use cases might happen, or we can't predict how the market itself might expand. There was a very famous exchange between Bill Gurley, who's a venture capitalist, and there's some finance professor from NYU. I forget his name, but basically, early in the history of Uber, the finance professor did some sort of valuation analysis based on the number of cabs and in New York City, or maybe it's in America. But he said, if Uber takes over the entire taxi market, which would be a great outcome, it's still overpriced today. And how is how is the current valuation possibly justified? And Bill Gurley responded, well, what if it expands the ride market? And what if places like suburbs, which never had a taxi infrastructure, begin to use Uber? Then the actual TAM is much bigger. And what if Uber expands into the rental car business, where instead of renting a car at your destination, you just take Ubers, and on and on and on. And so, that I think the disagreement between Haseeb and Santiago is to these two different mindsets, basically of um, the VC model of exponential growth with expanding markets and maybe even unpredictable TAMs versus the private equity discounted cash flow like spreadsheet type analysis. And then that raises the question, okay, what should be the right way to value crypto currently? And Jason, maybe I'll stop here and ask for your thoughts. Which of those two mental models should be used to value crypto, whether you're talking about L1s or DeFi protocols?
Yeah, I think I think with a DeFi protocol, it's a bit more clear cut, and the exponential model in my opinion, is probably the correct way to measure that or to invest in that. If we look at something like Polymarket, right, as an app built on crypto rails, they have probably 500K to a million users. I'm just kind of guessing based on past data. And they were recently valued at um, probably 10 billion or so. I'm not sure if they put that figure out there. But if you just divide those numbers, right, you get something around $10,000, $20,000 per user. So the VCs that are jumping into these apps like Polymarket that are much more consumer facing than a lot of the hardcore DeFi infrastructure that we're maybe more used to. They're thinking in terms of exponentials, right? They're saying, okay, 500K, this could be a global market, and like you said, there's probably many more use cases, and the number of markets on Polymarket could definitely also go up by orders of magnitudes. So I think that's a pretty clear cut case when you look at consumer facing apps or protocols, and then yeah, when you start to think about like how do you value an L1, I think it becomes a much more uh, tricky case. And in this discussion on X, there was I think the best arguments were that you maybe should think of it more like a currency, right? So the price of Ethereum has kind of gone through these waves, like the ICO cycle, right? Pushed the demand for ETH up a lot, and thus the price. And then DeFi summer and so forth did the same. And so it's much more driven just by kind of the supply and demand, which is just so multi-factored that I personally can't really model it in my head. Uh, so I'll leave it there.
Yeah, and to I'm going to share a screen again here. In terms of DeFi, like I think the biggest product market fit for Ethereum is DeFi, and I'm not talking about right now L1s like Monad or other L1s, which I'm not too bullish on, but because of the powerful network effects that Ethereum has, basically. But if you look at even just the DeFi metrics, we have not had a new high. We have not surpassed the November 2021 highs, and the I think one obvious apparent conclusion from this chart is that there's no way you could say there's exponential growth going on right now. If you go sideways for 4 years, almost 4 years, um, I think it's hard to argue that we're in the exponential growth phase. Having said that, there was a similar period from roughly like 2000 till 2010 where internet stocks, maybe not the number of users and the amount of usage and the daily active users and so forth, went sideways. And really almost all of the .com companies went to zero, with the exception of like Yahoo, eBay, um, Amazon, and even like Amazon was down like 95% at one point. But um, there was a resurgence after 2010 due to the social networks and mobile and so forth. But it's possible that we're in that 10-year stretch, or maybe it's not. Hopefully, it's for us. It's not 10 years sideways, but um, maybe we're in a stretch of 5 to 10 years of sideways metrics, and then the exponential growth could possibly resume as the industry matures. Nothing goes straight up, and there's this idea of punctuated equilibrium in like evolutionary biology, where if like things just nothing happens for a long time and then everything happens, right? And so I can see how if you are currently a traditional Wall Street investor, using spreadsheets and PE ratios or price to sales ratios and stuff, and you look at this chart, you're going to be very, very bearish.
Yeah, and one counter argument here is that this is one metric. If you were to go back to that chart and toggle on DEX volume, perps volume, stablecoin market caps, right? These are all up and to the right. And I think TVL might be a bit
I'm
of
not sure where to go.
a bit of a hard. Just hit the add metrics on that chart, on the TVL chart. Um, and TVL is a tricky metric because at some point the liquidity is sufficient for the average user to be able to swap in and out of what they want. And deeper liquidity, right? Sure, that's important for whales and institutional players coming into the space and so forth. But it also, I don't think, fully encapsulates like the the value proposition of DeFi and
Mm,
whether it's going
right.
up and down. Um, so yeah, just my 2 cents on that. Like perps volume, for example, right, was basically nothing back in
Yep.
2021 compared to what it is, and
Right.
that has certainly been exponential.
Right. And similarly, you could argue that in that 2000 to 2010 era, even though valuations at least were sideways to down for a long time, there was actually a lot of progress under the hood in terms of like daily and monthly active users of various networks.
Right.
Um, yeah. Anyway, that's I think that's all I had to discuss. Anything else to add, Jason?
No, that's a wrap. Yeah, check out the earn rewards campaign, stocking stuffer campaign on Rheo. Let us know what you think, and also let us know what you think about this discussion. Um, Thanks, guys.
See you later.